Investing a significant sum of money, like $50,000, can feel like a monumental task, especially when you're starting from scratch. The financial world is a labyrinth of complex terminology, fluctuating markets, and a seemingly endless array of investment options. It's easy to feel overwhelmed and paralyzed by the fear of making a wrong move. But here's the good news. With a well-thought-out strategy, you can put your money to work for you, building a foundation for a more secure financial future. This guide will walk you through a detailed plan for investing $50,000 for the remainder of 2025, breaking down each step into manageable, easy-to-understand actions. The latter half of 2025 presents a unique economic landscape. We're seeing a mix of encouraging signs and potential headwinds. On one hand, there's a sense of cautious optimism as the global economy continues to navigate the post-pandemic recovery. On the other hand, concerns about slowing economic growth, persistent inflation, and geopolitical uncertainties are creating a volatile market environment. This doesn't mean you should shy away from investing. In fact, periods of market fluctuation can present excellent buying opportunities for long-term investors. The key is to approach the market with a clear strategy, a diversified portfolio, and a healthy dose of patience. The investment philosophy underpinning this guide is built on three core principles. Diversification. You've probably heard the old adage, don't put all your eggs in one basket. This is the essence of diversification. By spreading your investments across different asset classes, stocks, bonds, real estate, etc., you can reduce your overall risk. If one investment performs poorly, the others can help to offset the losses. Long-term perspective, we're not looking for quick wins or trying to time the market. This is about building wealth steadily over time. We'll be focusing on investments with a proven track record of long-term growth. Risk management. Every investment carries some level of risk. Our goal is to manage that risk by making informed decisions, diversifying our portfolio, and only investing in assets that align with our risk tolerance. This guide will provide a step-by-step roadmap for allocating your $50,000. We'll start by building a solid financial foundation with an emergency fund. Then, we'll dive into the world of stock market investing, exploring how to build a diversified portfolio of low-cost index funds and ETFs. We'll also look at alternative investments like real estate and even a small, speculative foray into the world of cryptocurrency. Finally, we'll touch on the importance of retirement planning and how to make your investments work for you in the long run. So, take a deep breath and let's get started on this exciting journey to financial empowerment. By the end of this guide, you'll have a clear, actionable plan for investing your $50,000 and taking control of your financial future. The foundational layer, stability and emergency fund. Before we even think about investing in the stock market or any other asset class, we need to build a solid financial foundation. This starts with an emergency fund. An emergency fund is a pool of money set aside to cover unexpected financial emergencies, such as a job loss, a medical bill, or a major car repair. It's your financial safety net, and it's absolutely essential for your peace of mind and long-term financial security. Why is an emergency fund so important? Because life is unpredictable. Without an emergency fund, an unexpected expense could force you to go into debt, sell your investments at a loss, or make other poor financial decisions. An emergency fund gives you the freedom to navigate life's curveballs without derailing your financial goals. How much should you have in your emergency fund? A good rule of thumb is to have 3 to 6 months worth of living expenses saved up. This should be enough to cover your essential expenses, such as housing, food, transportation, and utilities. If you were to lose your income for a few months, with $50,000 to invest, you have a unique opportunity to fully fund your emergency fund right from the start. Let's say your monthly living expenses are around $3,000. That means you'll need an emergency fund of $9,000 to $18,000. For the sake of this guide, we'll allocate $10,000 to our emergency fund. This will give you a solid 3+ months of living expenses, providing a strong sense of security as you begin your investment journey. Now, where should you keep your emergency fund? The key is to keep it in a safe, liquid, and easily accessible account. You don't want to invest your emergency fund in the stock market, as you could lose money if you need to access it during a market downturn. A high-yield savings account is the perfect place for your emergency fund. High-yield savings accounts are online savings accounts that offer much higher interest rates than traditional brick-and-mortar banks. As of mid-2025, many online banks are offering annual percentage yields (APEs) of around 4.20% or even higher. This means your emergency fund will actually be growing and earning you a decent return while it's sitting there waiting for you. Here are some of the benefits of a high-yield savings account. Higher interest rates, as mentioned. You'll earn significantly more interest than you would with a traditional savings account. FDIC insurance. Most online banks are FDIC insured, which means your money is protected up to $250,000 per depositor, per insured bank. Liquidity. You can easily access your money when you need it. Most online banks allow you to transfer money to your checking account within a few business days. Low or no fees. Many online banks have no monthly maintenance fees or minimum balance requirements. By allocating the first $10,000 of your $50,000 to a high-yield savings account, you're not just setting aside money for a rainy day. You're building the foundation for a successful investment strategy. You're giving yourself the peace of mind to invest for the long term, knowing that you have a safety net in place to handle whatever life throws your way. The core growth engine. Stock market investing with our emergency fund fully funded. It's time to put the rest of our money to work in the stock market. The stock market is the most powerful wealth-building tool available to the average investor. Over the long term, the stock market has consistently delivered returns that have outpaced inflation, allowing investors to grow their wealth and achieve their financial goals. Now, I know what you might be thinking. The stock market is risky. I could lose all my money. And you're right. The stock market can be volatile in the short term, but over the long term, the trend has always been upward. The key to successful stock market investing is to have a long-term perspective, a diversified portfolio, and the discipline to stay the course even when the market is down. For a beginner investor, the best way to get started in the stock market is with low-cost index funds and exchange-traded funds, ETFs. These are professionally managed funds that hold a basket of hundreds or even thousands of different stocks. When you invest in an index fund or ETF, you're essentially buying a small piece of the entire market. This provides you with instant diversification, which is crucial for reducing your risk. Here's why index funds and ETFs are so great for beginners. Diversification, as mentioned, they provide instant diversification. So you're not putting all your eggs in one basket. Low costs. Index funds and ETFs have very low expense ratios, which means more of your money goes to work for you, not to the fund manager. Passive management. These funds are passively managed, which means they simply track a specific market index, like the S&P 500. This eliminates the need for you to pick individual stocks, which can be a difficult and time-consuming process. So, how should we allocate our remaining $40,000 to the stock market? We're going to build a diversified portfolio of index funds and ETFs that will give us exposure to different sectors of the market, both domestically and internationally. Domestic exposure. The U.S. market, the U.S. stock market, is the largest and most dynamic in the world. It's home to some of the most innovative and successful companies on the planet. That's why we're going to allocate a significant portion of our portfolio to a broad market index fund that tracks the S&P 500. The S&P 500 is an index that tracks the performance of 500 of the largest publicly traded companies in the U.S. When you invest in an S&P 500 index fund, you're investing in a diversified portfolio of blue-chip companies like Apple, Microsoft, Amazon, and Google. Allocate $15,000 to an S&P 500 index fund or ETF. Some excellent options to consider are Vanguard S&P 500 ETF VU. This is one of the largest and most popular S&P 500 ETFs with a very low expense ratio. iShares Core S&P 500 ETF. Another excellent option with a low expense ratio and a long track record of performance. Fidelity 500 Index Fund FXAIX. If you prefer a mutual fund, this is a great choice with a low expense ratio and no minimum investment. By investing in an S&P 500 index fund, you're getting broad exposure to the U.S. economy and its most successful companies. This will be the core of our stock market portfolio, providing a solid foundation for long-term growth. International diversification. The U.S. stock market is a great place to invest. It's not the only game in town. There are many other developed and emerging economies around the world with strong growth potential. By investing in an international index fund, we can diversify our portfolio and reduce our country's specific risk. We'll allocate $10,000 to an international index fund or ETF. This will give us exposure to companies in countries like Japan, Germany, the United Kingdom, and China. Some great options for international index funds include Vanguard Total International Stock ETF VXUS. This ETF provides broad exposure to both developed and emerging markets outside of the US. iShares Core MSCI Total International Stock ETF, another excellent option for broad international exposure with a low expense ratio. Fidelity Total International Index Fund, FTIHX, a great mutual fund option for international diversification. By adding an international index fund to our portfolio, we're not just diversifying our investments, we're also tapping into the growth potential of the global economy. This will help to smooth out our returns over the long term and reduce our overall risk. Small cap and growth potentials so far. We've focused on large, established companies in both the US and international markets. But what about smaller companies with higher growth potential? Small cap stocks are stocks of smaller companies that have the potential to grow much faster than their larger counterparts. Of course, with higher growth potential comes higher risk. But by allocating a small portion of our portfolio to a small cap index fund, we can add a little bit of extra growth potential to our portfolio. We'll allocate $5,000 to a small cap index fund or ETF. Some good options to consider are Vanguard Small Cap ETF VB. This ETF tracks the CRSP US Small Cap Index, providing broad exposure to the small cap market. iShares Russell 2000 ETF IWM. This ETF tracks the Russell 2000 Index, which is another popular benchmark for small cap stocks. In addition to small cap stocks, we can also consider a small allocation to a growth-oriented ETF. Growth ETFs focus on companies that are expected to grow at a faster rate than the overall market. These are often technology companies or other innovative businesses that are disrupting their industries. We'll allocate another $5,000 to a growth ETF such as Vanguard Growth ETF VUG. This ETF tracks the CRSP US Large Cap Growth Index, providing exposure to large cap growth stocks. Invesco QQQ Trust QQQ. This ETF tracks the NASDAQ 100 Index, which is heavily weighted towards technology and other growth-oriented companies. By adding a small allocation to small cap and growth funds, we're giving our portfolio a little extra kick of growth potential. Just remember that these investments are more volatile than our core holdings. So it's important to keep our allocation small and to have a long-term perspective. Dollar cost averaging. Now that we have our stock market portfolio all planned out, you might be tempted to invest all $40,000 at once. But there's a smarter way to do it, especially in a volatile market. It's called dollar cost averaging. Dollar cost averaging is the practice of investing a fixed amount of money at regular intervals regardless of what the market is doing. For example, instead of investing all $40,000 at once, you could invest $5,000 a month for the next 8 months. The benefit of dollar costs averaging is that it helps to reduce your risk. If the market goes down, your fixed investment will buy more shares. If the market goes up, it will buy fewer shares. Over time, this can help to smooth out your returns and reduce the impact of market volatility. For the rest of 2025, I would recommend using dollar cost averaging to invest your $40,000 in the stock market. This will help you to take advantage of any market dips and to build your portfolio in a disciplined and systematic way. Hedging and diversification. Alternative investments. While the stock market will be the core of our investment portfolio, it's always a good idea to diversify into other asset classes as well. Alternative investments are investments that fall outside of the traditional stock and bond categories. They can include things like real estate, commodities, and even CRYPTOCURRENCY. By adding a small allocation of alternative investments to our portfolio, we can further diversify our holdings and potentially increase our returns. Just remember that alternative investments can be more complex and carry higher risks than traditional investments. So it's important to do your research and to keep your allocations small. Real estate has always been a popular investment, and for good reason. It can provide a steady stream of rental income, as well as the potential for long-term appreciation. But for a beginner investor, buying a physical property can be a daunting and expensive proposition. That's where real estate investment trusts REITs come in. REITs are companies that own and operate income-producing real estate, such as apartment buildings, office buildings, and shopping centers. When you invest in a REIT, you're essentially buying a share of a large, diversified portfolio of real estate. REITs offer a number of benefits for investors. Diversification. They provide instant diversification across a wide range of properties and geographic locations. Liquidity. Unlike physical real estate, REITs are traded on the stock exchange, so you can easily buy and sell your shares. Passive income. REITs are required to pay out at least 90% of their taxable income to shareholders in the form of dividends. This can provide a steady stream of passive income. We'll allocate $5,000 to a REIT ETF. This will give us broad exposure to the real estate market without the hassle of being a landlord. Some good options to consider are Vanguard Real Estate, ETF VNQ. This is the largest REIT ETF on the market, with a diversified portfolio of over 180 different REITs. Schwab US REIT ETF, SCHH. Another excellent option with a low expense ratio and a focus on US real estate by adding a REIT ETF to our portfolio. We're diversifying into a new asset class and adding a potential source of passive income. A cautious foray into cryptocurrency is a hot topic in the investment world right now. Some people believe it's the future of finance, while others think it's a speculative bubble that's bound to burst. The truth is, no one really knows for sure what the future holds for cryptocurrency. We do know is that cryptocurrency is a very volatile and higher risk investment. The price of Bitcoin, the largest and most well-known cryptocurrency, has been known to swing wildly in a single day. That's why it's important to approach cryptocurrency with caution and to only invest what you're willing to lose. With that said, a small, speculative allocation to cryptocurrency can be a fun and potentially rewarding addition to a diversified portfolio. We'll allocate just $1,000 to cryptocurrency. This is a small enough amount that it won't derail our financial goals if it doesn't pan out, but it's enough to give us a taste of this exciting new asset class. For a beginner, the easiest way to invest in cryptocurrency is through a reputable cryptocurrency exchange like Coinbase or Gemini. These platforms make it easy to buy, sell, and store cryptocurrencies like Bitcoin and Ethereum. We'll split our $1,000 allocation between the two largest and most established cryptocurrencies, $500 in Bitcoin BTC. Bitcoin is the original cryptocurrency and the largest by market capitalization. It's often referred to as digital gold because of its limited supply and its potential as a store of value. $500. In Ethereum ETH, Ethereum is the second largest cryptocurrency and the leading platform for decentralized applications and non-fungible tokens NFTs. By investing a small amount in Bitcoin and Ethereum, we're getting exposure to the two most important players in the cryptocurrency space. Just remember that this is a speculative investment, so be prepared for a wild ride. Bonds for stability so far. Our portfolio has been heavily weighted towards growth assets, like stocks and cryptocurrency. But it's also important to have a small allocation to more stable investments like bonds. Bonds are essentially loans that you make to a government or a corporation. In return for your loan, you receive regular interest payments, and your principal is returned to you at the end of the loan term. Bonds are generally considered to be less risky than stocks, and they can provide a valuable source of stability and income in a portfolio. When the stock market is down, bonds often hold their value or even go up, which can help to cushion the blow. We'll allocate $4,000 to a total bond market, ETF. This will give us broad exposure to the entire U.S. bond market, including government bonds, corporate bonds, and mortgage-backed securities. A great option for this is the Vanguard Total Bond Market ETF BND. By adding a bond ETF to our portfolio, we're adding a layer of stability and diversification that will help to smooth out our returns over the long term. Retirement planning, a long-term perspective now that we have our investment portfolio all planned out. There's one more important topic to discuss: retirement planning. It might seem like a long way off, but the sooner you start saving for retirement, the better off you'll be, thanks to the power of compound interest. Even small contributions made early on can grow into a substantial nest egg over time. If you're self-employed or your employer doesn't offer a retirement plan, you have a number of great options for saving for retirement. Two of the most popular are the Solo 401k and the SEP IRA. Solo 401k. This is a great option for self-employed individuals with no employees. It allows you to contribute as both the employee and the employer, which means you can contribute a significant amount of money each year. SEP IRA, ASCP IRA is another great option for the self-employed. It's easy to set up and maintain, and it allows you to make large, tax-deductible contributions. The great thing about these retirement accounts is that they offer significant tax advantages. With a traditional Solo 401k or SEP IRA, your contributions are tax-deductible, which means they can lower your taxable income for the year. Your investments then grow tax-deferred, and you only pay taxes on your withdrawals in retirement. You can hold all of your stock market investments within your retirement account. This is a great way to shelter your investment gains from taxes and to maximize your long-term growth potential. I would strongly recommend opening a retirement account and contributing as much as you can each year. The investments we've outlined in this guide can be a great starting point for your retirement portfolio. Conclusion and next steps: investing $50,000 from scratch can be a life-changing experience. It's an opportunity to take control of your financial future and to build a foundation for a more secure and prosperous life. By following the plan outlined in this guide, you can put your money to work for you in a smart, diversified, and disciplined way. Let's recap our investment allocation. Emergency fund high-yield savings account, $10, stock market index funds and ETFs, $40,000 US large cap, S&P 500, $15,000 international, $10,000 US small cap, $5,000 US growth, $5 alternative investments, $6 real estate REIT ETF, $5,000 cryptocurrency, Bitcoin and Ethereum, $1 bonds. Total bond market $4. This is a well-diversified portfolio that will give you exposure to a wide range of asset classes, both domestically and internationally. It's a portfolio that's built for long-term growth, but it also has a layer of stability and risk management built in. Of course, this is just a guide. Your ideal investment allocation may be different depending on your age, risk tolerance, and financial goals. That's why it's so important to do your own research and to consider consulting with a qualified financial advisor. Once you've set up your portfolio, your work isn't done. It's important to regularly review your investments and to rebalance your portfolio at least once a year. Rebalancing is the process of selling some of your investments that have done well and buying more of the ones that have underperformed. This helps to keep your portfolio in line with your target asset allocation and to ensure that you're not taking on too much risk. Investing is a journey, not a destination. There will be ups and downs along the way, but if you stay the course, stick to your plan, and have a long-term perspective, you'll be well on your way to achieving your financial goals. So, take the first step today. Open that high-yield savings account, set up your brokerage account, and start putting your money to work for you. Your future self will thank you for it. Have a nice day.